Hello class and welcome back to my channel. So for this session, we will be discussing the accounting for merchandising activities. So there are several learning objectives here, but first let's explain first in detail, or let's pass through what are the expectations for this video. So first is that we want to describe what merchandising is, and let's explain what's the importance of this in the income statement and in the balance sheet. Okay, and then we will also differentiate perpetual against periodic, and then we will also analyze and record transactions for merchandise purchases and sales using a perpetual system. We will also pass through and go over how to prepare adjustments for a merchandising company, as well as preparing the merchandising company's income statements, and we will able to determine how to calculate for the gross profit margin and the markup on inventory cost. So here you have two types of sellers, okay? So the first one being the merchandiser and the second one being the wholesaler. So you might be wondering what's the difference between the two. So as a merchandiser, it is a company that earns net income by buying and selling merchandise. This activity, buying and selling, would probably the main differentiator for comparing against wholesaler. Wholesaler, on the other hand, would be a company that buys products from manufacturers or other wholesalers and sells them to retailers or other wholesalers. So let's just identify, right, like what's the example of a merchandiser and what's the example of a wholesaler. So for a wholesaler, probably the best company that we can attribute here would be Costco. Okay, if you've already visited Costco, so if you can see there are a lot of items that are being sold there, and most they are sold in package or in bundles. Okay, so in a way they are wholesalers for types of people like us, like regular consumers. Okay, but the concept of Costco is that they purchase from other manufacturers or from other wholesalers and sells it to their end users, which is us. Okay, so for a wholesaler, probably the another characteristic that may be attributed to it is that they are ordering or purchasing in bulk. Okay, on the other hand, merchandiser, the example of this would be your regular grocery stores. Okay, so this may either be a convenience store or your grocery store. So examples of our grocery stores here that we've known would be your Metro, will be your Loblaws, will be your No Frills. Okay, so in here, if you wanted to buy just a bottle of milk, then you would be able to buy in the grocery store. Okay, not unlike if you go to a wholesaler or a wholesale store. If you want to purchase a milk, then most probably you should purchase what the minimum order quantity that they are selling. Probably they will be selling this in boxes or in crates. But the main difference here, as I've mentioned, is that wholesaler, the company orders in bulk, while the merchandiser, they can just buy in pieces and sell this to the regular customers. In this slide is a difference of how to compute for the net income of a merchandiser versus a service company. Let's dwell our attention first to a service company. In here, we are seeing that it is very easy to determine what is the net profit for a service company, because since a service company is rendering its services or is performing an activity on behalf of its customer, okay, so the revenue they produce are actually labor or manpower. Okay, so here you can see here revenues, and then all of the deductions that are attached or that are inherent to these revenues would be your operating expenses. So what are examples of your operating expenses? So this might be your salaries expense, okay, your rent expense, your utilities expense, and other expenses that are attributable indirectly to the company. Okay? So this is the definition or the perfect samples for operating expenses. Okay? So for a service company, if you want to get the net income, you just deduct the revenue, okay, against your operating expenses. If your revenues are more than your expenses, then you would have a profit. However, if your operating expenses are more than your revenues, then you would be incurring a loss for that accounting period. The second type of company would be a merchandiser. Okay, so for a merchandiser, as you've explained a while ago, is that this is a business engaged in the buying and selling. Okay, so this means when the company is buying something, right? The purpose of why they're purchasing all of these items is that because they want to sell it to other people or other businesses or other consumers. Okay, so the items that they purchase, okay, for sale would be part of your goods sold. So here, the buying activities and the selling activity would be on the sales. Okay, so here if you want to identify something, okay, so let's say for example I have a clothing line, okay, but I sell shirts but I don't manufacture them, but instead I purchase these shirts to other manufacturers or from other entities, and what I do is that I put a markup on the cost of that shirt. Okay, so say for example I purchased one shirt for $50. Okay, and then I want to sell this shirt, so bought or cost, and I want to sell this selling for $100. So what would be our assumption here? So this means that I have what? 100% markup based on my cost. Okay? So if this means that if I will be successful enough to be able to sell this shirt, then I would be having a sales of $100, and the cost of goods sold would just simply mean the cost or the purchase price when you bought the shirt, which is $50. So the gross profit is simply just the difference between your sales and cost of goods sold. So your gross profit here would be $50, which is 100 minus 50. And then of course, this will not be your net profit yet because you still have to deduct any expenses arising from your operations. And that would be your salaries, your rent, and your utilities. Say for example, your salaries for the accounting period was 10, your rent was 5, and your utilities was 5. Thus having a total operating expenses of $20. Then now from this, when you deduct your gross profit against your operating expenses, then you would be arriving at your profit, which is $30. So there's a bit of complexity when accounting for the merchandising company because you have to integrate what is the amount of your cost of goods sold, okay? And how much sales were you able to generate when you sold these items, okay? So from there you would be getting the difference, and that difference will be the gross profit. And in here, the operating expenses will be deducted against your gross profit to arrive now in your net profit. So this chapter or this topic all talks about the activities regarding inventory. So let's define what inventory is. Inventory is a product that a company owns for the purpose of selling to customers. So to be classified or to be categorized as inventory, which is an asset, it must meet the two requirements. First, the company must have ownership into that item, and that ownership, they have the objective of selling it to their customers. So this is the first requirement, and this is the second requirement. It is often also referred to as merchandise inventory. And always, in all cases, inventory is classified as a current asset. So the cost of a merchandise inventory would be on these three activities. You should include as part of the cost of an inventory, okay, the purchase price, okay, whatever the amount that is you paid for that specific item that you purchase. Let's say, for example, we are a merchandiser who sells televisions, okay? So let's say we are purchasing our televisions exclusively from Samsung. And we are selling the 2023 LED TV. This is the specific type, okay? And Samsung is selling it to us for $200 per set, okay? So let's say, for example, during the day, okay, we purchased, as the owner of the company, we purchased one set of television, okay? So that means we need to pay $200, which now means that it is the purchase price. Of course, this television is not yet on your store or not yet in your office, right? So hence there would be an inherent delivery fee or shipping costs that might be attached to it. Let's say, for example, the amount that Samsung, okay, or any courier services charge to you, okay, to bring this item to your office or into your store amounted to $20, okay, then we have to add it as part of your cost of merchandise, okay? So $20 here. Okay, now that the television is already in your store as a result of the delivery by the courier services, okay, if you make any improvements to the item that you will be selling, let's say, for example, this television, let's say that you incurred marketing fees which are directly attributable to make the item saleable, okay, to make it more presentable, to make it more enticing to the customers, okay, so that it could be easily sold to them, okay, which we also call like other cost, okay, then that should also be included as part of the cost of your merchandise inventory. Let's say your marketing cost for that specific activity amounted to $30. So the answer here, if I ask you how much is the total cost of your merchandise inventory, that television, then the answer would be $200, which is your purchase price. Your shipping cost of $20, so it's already now $220, plus your other cost, which is the marketing cost amounting to $30. Sum all of this and it will be $250. Okay, so in this slide, it is worth noting that you should not only include the amount that you paid to your supplier or to Samsung, okay? You also need to add the other expenses, meaning the shipping cost, okay? And other costs, which would be like your, in this example, the marketing expenses or the marketing cost. And other examples of your other costs would be your insurances, okay, or your taxes. So we should include it as part of the overall cost of your inventory. So shown here is the merchandising cost flow. So this tip here, okay, the tip here is that above this, on the upper hand of the screen, the beginning merchandise inventory and your net cost of purchases, this has an effect of increasing the balance of your inventory. Okay? While the bottom half of your screen, which is your cost of goods sold and your ending merchandise inventory, this would show you the balances of your inventory which that actually decreased. Okay? So it says here number 1, beginning merchandise inventory. Beginning meaning the start of the accounting period. If you're talking about the month of July 2023, so this would represent as your July 1. So overall, beginning merchandise inventory or your July 1 inventory is also synonymous with the word opening balance. Okay? Number 2, net cost of purchases. So these are all of the purchase or the buying activities that you have incurred, okay, or you transacted with during the month. Okay? So this all talks about the buying activities. That's why we noted it that it will only increase our inventory asset. Okay? Number 3, it says your merchandise available for sale. Okay? As when we define inventory, it says there that the company should own that item and that it has the objective of selling it to its customers. Okay? So these items that we are holding, this inventory that we are holding, the ownership that we have in number 1 and the ownership that we have in number 2, you sum this up, okay? And you would be arriving at your merchandise available for sale. This merchandise available for sale, this just tells you that the items or the inventory that you are holding has the objective of being sold to your customers. Okay? So that's the main reason. So let's just take for example number 1, your beginning inventory. Say for your opening balance as of July 1st was $100. And then during the month, the net cost of purchases, okay, you had a total of $900 of purchases during the month. This means that for the month of July, you had the chance to sell $1,000 worth of inventory available for sale. Okay? So from this $1,000, then you would be now be able to identify that, okay, I'm holding $1,000 worth of inventory. What am I supposed to do here? Of course, what you need to do as a seller is what? Is to promote this to your customers so that they will purchase it to you. Okay, for you to generate revenue. Let's say that during the month of July, you were successfully able to sell, okay, sold $600 worth of inventory. Then this would only mean that out of the $1,000 that you held initially, and $600 of it was already purchased by your customer, then this just means that you just have a remaining of $400 worth of inventory left. Okay? So basically, the ending balance, okay, which is the 400, this will actually be the August 2023 opening or beginning balance. Okay? So here, your beginning, if you add the beginning inventory with your purchases, you would be arriving at your available for sale. And this available for sale, you would need to deduct anything that you were able to sell, which is your cost of goods sold, and then you will arrive at the ending merchandise inventory. There are two types in accounting for merchandise inventory. You would have your perpetual inventory, your perpetual system or your periodic system. Perpetual is advisable by most of accountants because it provides an up-to-date record of the amount of merchandise inventory on hand and the cost of goods sold to date. So it is worth noting the word here, to date. So means continuous or updated. On the other hand, it says here periodic. Okay, periodic meaning at a point in time, within a time frame. So periodic requires a physical count of goods to determine the amount of merchandise inventory in hand and the cost of goods sold. It is encouraged to use the perpetual because it gives you the current status of your merchandise inventory asset account balance. Because every time a transaction happens, may either that you purchased something or you were able to sell something, it is reflected and recorded in your accounting books in a timely manner. All right? So that's the main advantage between the periodic. Okay? So perpetual, this shows you the up-to-date balance. On the other hand, periodic, you would need to perform a physical count or an inventory count for you to determine the balance of your merchandise inventory asset account. So in this slide is an example of how to journalize or how to write a journal entry for a perpetual system transaction. Okay? So it says here, the basis or the story of this transaction is that you, as the seller, you purchase merchandise on credit. On credit means you purchased something on account. All right? So this means that you didn't pay actual cash to the seller, but rather you just gave them your promise that you will pay them sometime in the future. Okay? So in this case, you would be recognizing a liability. That's why you credited accounts payable, right? Amounting to 1,200. And then, of course, you purchase something, right? And that something is an inventory. And by now, you should know that inventory is an asset. So our asset account increased. That's why we debited merchandise inventory for the same amount of 1,200. So that's the first transaction. The second transaction, however, this shows you that on November 5, 3 days after you made the purchase, okay, you determined or you noticed that some of the items that you received are defective, okay, or probably damaged, okay, not of good quality. So what they need to do? You would need to return these damaged items to your seller. Now, if you return these items to your seller, what will happen? Two things. First, your initial merchandise, okay, that you recognize on November 2 would now be lessened by the quantity or by the amount that you actually returned. So that's the first one. And the second one is that the liability, okay, or your promise to your seller that you will pay them sometime, that should also be decreased as a result of the merchandise inventory that you gave back to your seller. Of course, it is just right that your liability, okay, be decreased as a result of your return to the seller. Okay? So on November 5, what happened here is that we noticed that $300 worth of the merchandise inventory that we received on November 2 was not of good quality. Okay? Probably damaged or obsolete. So in this case, we would need to decrease our asset, our merchandise inventory. That's why we credited it for $300. And of course, the accounts payable, the promise that we that we originally recognized on November 2, we also have to decrease it for the amount of $300 by debiting accounts payable, right? So whatever happens here, okay, again, for every journal entry that you prepare, you should have a detailed record of these accounts. Okay? So in this slide, this shows you how to account, okay, or how to apply discounts. But first, let's identify what's the purpose of a discount. So it is a deduction from the invoice price. Of course, discount just means reduction. It is a deduction from the invoice price granted to induce early payments of the amount due. Example is 210 and 30. You would be seeing this 210 and 30 numerous times, probably in the quiz, in the test, or in the actual accounting world. Let me explain to you what 210 and 30 means. So 30 or N30 means that this is your credit period. Credit period means that this is the time frame wherein you need to pay. Okay? So within 30 days or on the 30th day after your purchase, you should now pay your seller. On the other hand, if you are the business owner, if you are the seller, then this is the maximum amount of days or time that your customer needs to pay you. Okay? So after 30 days, you have to collect from your customer the amount that they owe to you. So N30 here would be the maximum days. So this is not just always N30. So this may either be N45, meaning the credit period is 45 days, or if it is N60 or N90, this just simply means that your credit period is 60 or 90 days. Now, the important thing here is what 2 and 10 means. Let's decipher first what is 2. So the 2 here, okay, the 2, this shows you the percentage amount of the discount. In this case, it's established at 2. So this is 2% discount. Okay? So this means that a customer is qualified to obtain a 2% discount. Now you might be wondering, sir, what is the requirement or the qualification for the customer, okay, to have this 2% discount? This is where the 10% comes in, or the 10 comes in. 10 here means that this is the discount period. Discount period means that within 10 days after the purchase, on or before the 10th day after the date of purchase, if the customer, okay, pays you the full amount of the invoice price, then that customer will be entitled to a 2% discount. Okay? So let's take it for an example later. But let me just illustrate to you what 2, 10, and 30 means. We are on the month of July 2023. And on July 1, okay, you were able to sell $100 you were able to sell $100 worth of inventory or item, okay? So on July 1, your customer told you, hey Dale, I don't have cash today. Can I just pay you tomorrow or in the near future? Then you told your customer, sure, you can pay me N30 after 30 days. So that is your N. And you even gave your customer a promo. You told your customer that, you know what, if you pay within 10 days, I would give you a 2% discount. So that will now represent as your 210. Okay? So this just simply means that within the period of July 1 to 10, your customer is entitled to a 2% discount. Okay? However, if your customer pays between the time of July 11 to July 31st, then no more discount. So that's just simply what 210 means. Okay? Say for example, your customer paid on July 10. Then your customer would be entitled to a $2 discount. And he would only need to pay $98. Any payments made after July 10 or July 11 going forward would not be subject to any discounts anymore. In here, we're just taking, for an example, again, we're just going back to this transaction. Again, the story here is that on November 2, you were able to sell, you purchased an inventory for 1,200. However, you determined that $300 of which was defective. That's why you returned it. Now, the balance of your merchandise inventory is just $900. Okay? So it says here you purchased on November 2, okay? And the term was 210 and 30. Again, 10 here means that if you pay within 10 days after the date of purchase, which is November 2, then you would be entitled to a 2% discount. Okay? So let's focus on case number 1 here. It says that, okay, on case 1, on November 12, your customer paid you on November 12, which is within 10 days after November 2, correct? So in this case, you would need to give your customer a 2% discount. Now, where would you get that 2% discount? Where will you multiply it? You would be multiplying it against your invoice price, which is the accounts payable of $900. So what you need to do is just multiply 2% by $900. You would be getting $18, which is the discount. Okay, and then deduct it in your merchandise inventory. Okay, and the remaining amount, which is 900 minus 19, the 882, this is the actual cash that you will be receiving from your customer. Okay, now for case 2, let me just change this to 13, which is 11 days after November 2. In case 2, your customer is no longer entitled to receive that percentage discount because the payment was made 10 days after the date of initial purchase. In this case, they are not entitled to the discount anymore. Here, we're just showing you the detailed record for each account that we accounted for. Okay, so let's take this for an example. So here we will be practicing our skills on how to journalize, okay, a purchase of inventory and a return, as well as the payment of the discount. So our first entry, it says here, purchase 650 units or 650 pieces of merchandise inventory at $5 per unit. Furthermore, our seller gave us a promotion, okay, with terms of 210 and 30. So let's make the first journal entry first. So it says here that we purchased 650 pieces of merchandise at $5 per unit. So it means that we paid a total of, to get the total invoice price, multiply 650 by 5, you would be getting the amount of 3,250. How do you journalize it? So October 6, you should write here, debit the merchandise inventory, which is an asset, amounting to 3,250, and then credit accounts payable as a result of the promise, okay, that you would be paying your customers soon for 3,250 also. Okay. So in here, we're just setting up the journal entry wherein we received the asset and we recognize the liability or the promise to our seller. 2 days after, on October 8th, okay, when we inspected or we checked the items that we received, we noted that out of the 650 units that we received, 25 of which are defective. So what did we do? We returned this to our seller. So before, we had 3,250 minus 25. This means that we only have a total of 3,225 units of inventory after the return. Okay? So now, this 25 that you returned, this should be shown as a decrease in your accounts payable and in your merchandise inventory. Okay? So, if you're gonna return it, right? So your entry here initially would be what? Just the reverse of your first entry. Since we are decreasing the amount of our asset, then we would need to put the merchandise inventory in the credit, okay? And then, of course, we would need to decrease our liability to our seller by debiting the accounts payable. However, you might be wondering, what is the amount that should I be putting? Okay, so the amount that you should be assigning is 25, which is the number of items that you return to your customer, times the price per unit, which is $5. In this case, 25 times $5, you would be getting an amount of $125. So decrease your accounts payable by 125 and decrease also your merchandise inventory, which is an asset, by $125. So now the time has come. 2 days after the return, your customer came to your store and told you that, hey, we went to the store of our seller and we told them that we are paying today. Okay? And what was the offer initially by our seller? So they told us that we would be getting a 2% discount if we pay within 10 days after the date of purchase. The date of purchase is October 6. If you add 10 days here, then you would be getting 16. This means that this promotion would run until October 16. And checking the entries here, it says here that on October 10, we actually paid for the merchandise inventory, the accounts payable. So what do we need to do is we now need to incorporate the discount in our transaction. And as I've mentioned a while ago in the previous screen, there are 3 accounts that are affected when we are paying for or when we are applying for the discount. So on October 10, our entries would be, of course, we would need to close out the amount of our accounts payable. Okay? By debiting it for the amount of 3,125. And then we would be getting that discounted amount which would be reflected in your as a reduction in your merchandise inventory, which is multiply 3,125 by 2%, you would be getting 62.5. So this is the actual discount that we received. Okay? And then of course we paid for the accounts payable, then this would all be cash. Since we were able to receive cash, then we should be paying less, right? And when we're paying for less, we just get the difference of the 3125, okay, the updated invoice price minus the discount that we had, which is 62.5, then that would give us, or the obligation to pay, 3,062.50 cents, okay, as an outflow in our cash. Again, initially, we were supposed to pay the full amount of 3,250 if there was no promotion, okay? However, since our seller offered us this promotion that if we pay within 10 days, we will be receiving 2% discount, then the total cash payment that we made, okay, was just 3,062.50 centavos. Okay, so there's a big difference amounting to 62.5 worth of discount. So in this slide, this now talks about who assumes for the shipping cost. As I mentioned to you a while ago, the cost of your inventory would be a combination of your purchase price, your shipping cost, plus other cost. So we are now in number 2, which is your shipping cost. This diagram just shows you that initially the item is in the seller, okay, and it is being passed to the hands of the buyer, okay. So you're also seeing here these words, FOB shipping point and FOB destination, okay. As a general rule, keep this in mind. You might want to memorize this or try to understand this. When the terms is exclusively mentioned as FOB shipping point, this means that the buyer pays the shipping charges, or the customer pays for the shipping cost or the delivery fee. Okay? On the other hand, if the terms is FOB destination, then the seller assumes for the shipping charges, or the seller is the one who actually pays for the delivery cost. Okay, so that's just the main difference between FOB shipping point and FOB destination. Okay, so in this slide, this is just showing you on how to prepare for the journal entry for the merchandise, for the transportation cost, okay, that you incur as a result of your purchase of the merchandise inventory. So since we include the shipping cost or the delivery fee as part of our cost of inventory, then we should increase by debiting the merchandise inventory asset account, okay, and then crediting cash, okay, the payment that we made as a result of the delivery by 75. Okay, so we increased here merchandise inventory because transportation cost, right, is part of your inventory cost, total inventory cost. So in this slide and the succeeding two, we are just putting ourselves that as if we are now the seller, okay? So we are now the seller, meaning that we are the ones who are offering to our customers the discount, okay? So in this transaction, it says here that on November 12, okay, we were able to sell $1,000 worth of items, okay, worth of sales. $1,000, $1,000. Again, this is our sales. Since merchandisers is in the business of buying and selling, then they purchase an item from other sellers, right? They put a markup on it and they sell these items to other customers. Okay? So this $1,000 is already the marked up cost or the selling price. The actual amount that we actually purchased this from the other suppliers actually was just $600. Okay? So this means that initially when we were when we did not make the sale yet to our customers for the $1,000, we still have merchandise inventory, which is an asset of $600, okay? And the cost of goods sold, which is an expense, was still zero. Okay? However, when you made a sale or when you generated revenue as a result of the transactions you had with your customer, then your asset of a merchandise inventory, this now needs to be decreased. And when you decrease your asset, you put it on the credit side. That's why we put here credit merchandise inventory to decrease the amount of our asset by $600. And we put this inventory as part of your cost of goods sold, which is an expense, okay? And if you want to increase our expense, we put it on the debit side. Thus, we are debiting cost of goods sold by $600. It is also worth noting that we are offering our customer a 2% discount if payment will be made within 10 days. And the credit period is at 60 days. So now let's calculate the first, these two different scenarios. First, what if our customer pays in 60 days? Okay. So on November 12 is our transaction. Okay. November 12 plus 60 days. That date would be January 11. Okay. So this is the maximum amount of time that your customer should pay. Okay. And the term here was 210 and 60. 210 and 60. First question that you need to ask yourself, if we're talking about case number 1, did the customer pay within 10 days? Since we're already in January 11, which is 60 days after November 12, then the answer would be no discount. So this means that your customer needs to pay you, or you need to collect from your customer the full amount of $1,000, okay? Which is the sales that you made or the accounts receivable that you recognized. So here, just decrease your accounts receivable as a result of the actual collection that you made by crediting it, and increase your cash asset account by $1,000, okay? So before you were just given a promise of $1,000, now that promise was actually converted into actual cash for $1,000. On the other hand, on case number 2, your customer paid you within 10 days. Okay? So November 12 was your date of purchase. Your customer paid you on November 22. That is still within 10 days. So if your customer is within the discount period, then he or she should be qualified for the 2% discount. And how do you calculate for the 2% discount? Okay, still write off your accounts receivable, okay, because actual payment has now already been made. So again, credit accounts receivable, okay, for $1,000. And supposedly, if your customer did not pay you within 10 days, then he or she should be entitled to pay you the full amount of 1,000, right? However, since he or she was entitled to a 2% discount, then you would need to give them a 2% discount on the accounts receivable that you have. So $1,000 by multiplied by 2%, your customer is entitled to a 20% discount. Okay, that's why we debit sales discount. Okay, and then as a result of this sales discount or this promotion that we provided to our customer, then unfortunately we would be receiving less cash as expected, right? We will now be receiving just $980 instead of $1,000. Okay? So similar with your how returns and allowances are accounted for in your purchases. In this case, you also adjust for your sales, okay, that you've made, and you also increase your merchandise inventory and decrease your cost of goods sold for an expense whenever your customer gives you back your item as a result of it being obsolete, broken, or damaged. So under perpetual merchandise inventory, we have this adjustment called shrinkage. Okay? So let me tell you first what perpetual merchandise inventory system, okay? It keeps a running total of inventory levels by recording sales and purchase transactions. Class, that is why it is called perpetual, meaning it is forever, it is continuous, it is updated time and time again. So these updates that are being made is the transactions such as our sale and purchases. Periodic adjustments must be made to account for shrinkage. Shrinkage means these are the losses due to theft or deterioration of merchandise inventory. Looking at this slide, at the first part, you would see here that we have inventory per accounting books, okay? The amount that we recorded in our accounting records, $21,250, okay? And on the second line, it shows you that during our physical inspection of our merchandise inventory, probably in our warehouse, in our store, in our office, we determined that there is only 21,000 worth of inventory on hand. Okay? So there is $250 worth of inventory that is missing. Okay? When we say missing, it might be stolen, right? By any employee, or it might be broken, right? As a result of miscarriage, or it was just simply damaged as a result of its nature. Okay, probably just with humidity, it was infected by pests, stuff like that. Okay, so those kind of activities we also accounted for. Okay, in this case, unfortunately, per our accounting books, we have $21,250. However, when we counted it, we noticed that only $21,000 of inventory was worth keeping. Thus, the difference of $250 would now need to be expensed. Okay? And when we expense it, we should debit cost of goods sold. Okay? For the shrinkage amount of $250, and we would also need to decrease our asset by crediting merchandise inventory by $250 also. So in here we have your income statement formats. So the typical types that we have would be your multi-step, your classified multi-step, and your single step. We won't be going on this on detail as this is not part of our curriculum. Like we will not be preparing an income statement for a merchandise entity, but I will just be running this through for discussion purposes. So under the classified multi-step format, it is very detailed. The reason why it is very detailed because it is usually used for internal reporting. When we are um, when we are working internally, of course, we would need like as much many details that we need in order for us to make our quantitative analysis. As you can see, it is very lengthy. The second type would be your multi-step format. So this is encouraged, okay, for a format if you want to have an external reporting, okay. Probably you want to report this to your boss, probably to the CFO, to your managers, okay. In here, this shows you like the highlights of each expense that you have or each account that you have, okay. So this is more condensed, if I may say. Then finally, you have here your single step format, which is also for external reporting. But here it just shows you like in a very small picture, the overall results of your income statement for a merchandising entity. So in this last slide, we would like to determine the formula on how to arrive for the gross profit margin. So the gross profit in each dollar of sales, okay? So the gross profit actually is just the your net sales, okay, minus your cost of goods sold. Okay, then you would be arriving at your gross profit. So it may be tracked over time and or compared to similar businesses, okay, for comparison analysis. And it may also be calculated for wholesale business, departments, and products. So class, this might be part of your test or quiz. So just apply this formula to arrive at a gross profit margin. So that is just deducting your net sales minus your goods cost of goods sold, which is ultimately your gross profit, okay, all over your net sales. Then you would be arriving at your gross profit margin. If you have any questions, please feel free to pin it down in the comment section, and you may also raise it during one of our classes. Thank you, everyone. Bye bye.